how much of a time bomb is this $40 trillion debt?
It's a very serious problem. We should have been panicking about this 20 years ago.
Do you think that President Trump's economic strategy is actually going to work?
I'm not quite sure what President Trump's economic strategy is. If you say there's an affordability agenda, and then you go to war in Iran in a way that raises gasoline prices an awful lot, he says he wants lower interest rates, and yet is presiding over a government that is spending even more money. We're beginning to see these contradictions clash with each other more and more.
Hello and welcome to the Fourcast. I'm Ciaran Jenkins. Is Donald Trump driving the world economy off a cliff while many of you are on your summer holidays? The size of America's debt has just passed $40 trillion. This comes as Trump's tariffs are pushing up prices. His tax cuts are adding to the deficit, and the war with Iran, of course, has sent oil prices soaring. Now, bond markets are turning on the president. The US Treasury has tried to step in and calm the markets, but it doesn't appear to have worked. So what exactly is going on? Is it just a wobble in the bond markets, or a sign of something way worse to come? Well, to discuss, I'm joined by Pippa Malmgren, who served as an economic advisor to President Bush, and the Economist's Archie Hall. Pippa, $40 trillion of debt. What is happening?
Well, first, this has been a problem for a very long time. And what's interesting is the new administration came in and said, this is a break glass in an emergency moment. We have to fix this debt problem. Now people see it because it's hit this number. But it's not that it hasn't been recognized by the administration. So they've got a strategy for dealing with it. But I think right now everybody's just reverberating from the shock that we ever hit this number. But having worked in Washington over many decades, bottom line is people have been thinking this problem was always 10 years away for decades. And now the problem is really with us.
Yeah, Archie, tell us what's going on with bonds, because that's what's really frightening people, isn't it?
Yes, the yields are creeping up. And so bonds, it's getting more and more expensive for governments to borrow, both America, but also throughout the world. Crazy moves in Japan, pretty big moves in Britain and elsewhere. And that's been a lot of the story of the past year or so, has been markets going, oh gosh, there's a lot of borrowing going on, both by governments and by private businesses, particularly around building AI data centers and that sort of thing. And you combine that, and that's a lot for the bond market to swallow.
Yeah, just break it down even more for us. Okay, so what is happening with US government bonds and borrowing in particular, and why is that sort of making alarm bells, red sirens, sort of Homer Simpson style, sitting in the Springfield nuclear facility, everything flashing red?
Absolutely. So, I mean, when there was last a big panic about US government debt, which was, call it 10, 15 years ago during Obama's tenure, then you had scary numbers being hit, smaller numbers than today, but still scary numbers. But also, it was actually pretty cheap for the government to borrow. Bond yields were pretty low. And that reflected the fact that America had had a pretty sluggish recovery from the financial crisis, and also that the Federal Reserve was doing a lot of kind of quantitative easing, sort of almost creating money to buy bonds to push those yields down. And so even if the debt numbers were quite scary, at the very least, it wasn't that expensive for the government to borrow. And that was always sort of a reassurance and a reason not to fully let the alarm bells and the glass break and everyone truly panic. Where now, if you fast forward to today, the 10 or 15 years, you have even more government debt, even bigger and scarier numbers, the 40 trillion, of course, and also, I mean, well past the kind of size of American GDP in government debt, which is sort of the size of everything the American economy produces in any given year, which is pretty scary. And then also you have the situation where it's getting really expensive for the government to borrow. And so that means, given you have this debt and you're paying interest on this debt, just like anyone would when they take out a mortgage or paying credit card debt or whatever else, you're paying interest on that debt. That interest has got vastly more expensive. And you're also borrowing a whole bunch of money for everything else the government does, for its pension schemes, for all manner of transfers, for big uplift in defense recently. The list goes on. You combine those things of a lot of spending anyway, and then also actually even just servicing the debt you have, even paying the interest on the debt you have, is now getting more expensive. And in the past year, it's just got more and more expensive. And I think that's one of the reasons why even a lot of people who were quite relaxed 10, 15 years ago are a bit more panicked now.
So how does this happen, though? How does it creep up and up and up so it gets more expensive?
Well, again, once you start hitting a number like we're seeing, 40 trillion, basically everyone panics. It's funny that they don't panic, half a trillion less. We should have been panicking about this literally 20 years ago. But everyone just keeps finding a way to muddle through and thinks we'll deal with it later.
So what about Trump, what he's actually doing? Because he's had a sort of, 1 minute he's raising tariffs on Canada by 50%. The next minute he's not. He's started a war with Iran. I mean, presumably that's a factor.
It's a huge factor because there's suddenly a recognition of the unbelievable cost, the financial cost of being at war with Iran, which of course the White House had thought would be quick and easy, and it turned out to be complex. So as it seems to be a quagmire, the markets are repricing what will be the cost to continue doing this. That's part of it. It's also the recognition if the U.S. can't impose its will in that situation, the power of the United States is seen to be diminished. Therefore, the risks associated with investing in the U.S. economy are heightened. So that is definitely part of it. It's also the spending that's been happening recently. And again, a lack of confidence in what is the solution, what's the way out. Don't have the left and the right speaking to each other in the United States, almost impossible to get any kind of bipartisan agreement on anything. That's a further contributing factor.
Do you think, Archie, that President Trump's economic strategy, what he's trying to do here, is actually going to work?
I'm not quite sure what President Trump's economic strategy is. If you say there's an affordability agenda, and then you go to war in Iran in a way that raises gasoline prices an awful lot, which is the most salient price for any American, the price at the pump, that sort of pushes slightly against that. He says he wants lower interest rates, and yet is presiding over a government that is spending even more money. The One Big Beautiful Bill Act was a vast expansion even in the amount of money that the American government was borrowing. And so I think part of the difficulty is, and British listeners might be familiar with the phrase cakeism, the sort of notion you can have your cake and eat it. And this was popular with Boris Johnson and others during the Brexit conversations, that really you don't need to face these trade-offs. You can just do and have everything. I think there's a bit of cakeism to America's economic strategy right now, where on the one hand you hear affordability, get interest rates down, and then on the other hand, you have things like tariffs, which at least in the short term are raising inflation. You have the war in Iran. You have general expansion of government borrowing. A lot of things that kind of push in the other direction. I think Donald Trump, actually said at one point he wanted housing both to be more affordable, but also house prices not to go down. And obviously those two things can't really happen at the same time. And so I think we're beginning to see these contradictions kind of clash with each other more and more.
Because that's how he will be judged by a lot of the American people, isn't it, Pippa?
Yeah, the public always judge the president, whoever they are, on the condition of the economy. So then you have to look at what is happening to the U.S. economy in different parts of the country. And I think one issue that all international observers have with the U.S. is that they tend to think that what is happening on the coastlines is America and don't pay much attention to the middle. But the middle is where the dynamism is in the U.S. economy today. I'm based in Texas because it's being referred to as America's Shenzhen, meaning it is like China's most important industrial manufacturing center. And I definitely see that that's very, very real. So one can have very different impressions of the U.S. economy depending on which part of the economy you're talking to. So that's it. And second, nothing that the president does right now is going to happen in time for the midterm elections. And that's part of what is causing the bond market problem, is the realization that there's a chance the president's going to lose the midterm elections. And then there'll be more gridlock in Washington than we even have right now.
And let's not forget, I think the first time he ran, he promised to eliminate the national debt, didn't he?
Yeah, he is still in the view that that's where he's heading. I guess it's a sort of, you have to hit the gas to stop, to get to where you want to be so you can stop the car. But until it's done and proven that this has happened, everyone has doubts.
And Archie, what exactly do we mean when we say the markets are getting jittery and have lost confidence? I mean, who are these shadowy people who are making these massive consequential decisions?
It's all of us. I think in some ways we think the bond market it's either an abstract, impersonal, scary force, or it's some men in pinstripe suits somewhere at the top of a very tall building. But mostly it's us. Anyone who has a pension, almost certainly a pretty good chunk of that is invested in bonds, very possibly in American government bonds. Certainly if you're in America, that's going to be true. And much of the kind of capital in the world kind of goes from that. It's just, you look around at kind of who has wealth, and yes, billionaires have wealth, but so do, if you add up everyone else, that get to a pretty big pile. And so the question is, when governments are borrowing money, what they're really trying to do is sell a product to us. They're trying to sell a thing where it's, you give me some money now, and I'll give you some money gradually over the next 10, 20, 30, however many it is years, and pay you back. And exactly how much money the government needs to give people to persuade it to lend them money now is that price. And so all we're seeing, this is not a sort of cabal of hedge funds manipulating markets or anything. It's just as simple as the totality of people who own capital, which in many cases just pension fund managers working for people like you or I, is deciding that actually, gosh, if I'm going to lend the American government money, that's looking like a riskier proposition than it was even a year ago. And I need a bit more to make that work for me.
And Pippa, there is an impact, isn't there? A sort of follow through to all of us as consumers, as people with pensions and mortgages and all the rest of it in the US and in the rest of the world.
Yeah, absolutely, because the United States is sort of the benchmark that everything else is priced off of, as they say in the market, meaning prices around the world are dependent on this sort of core fundamental underlying price. But there's another element of this, which is people adjust to different levels of interest rates. You know, when I was in high school, interest rates at one point were hitting 20% in the United States. It was a devastating period of history, and yet the economy totally survived it. Difficult. What it did is it forced people to be more sensible about what they were investing in. So we've had a huge amount of free money ever since the bailout of the financial crisis. And that free money has given us a number of results. One of them is higher inflation, which was very painful for most people. To get rid of that, normally you would raise interest rates a little bit. So think about it as like running on a running machine, and you lift the tilt on the thing, right? Everyone says, oh, I don't want higher interest rates. But the reality is, as we're forced to run on that machine, we get a little healthier. The question is, at what point does it start to kill you? I don't think we're anywhere near that point, given history. But when people have been, eating free donuts for a long time and you ask them to deal with higher interest rates, it feels extremely painful.
I certainly don't want to try a treadmill that can kill you.
Yes.
That's not a treadmill I want to try. But it is true, isn't it, Archie, that this is not just some abstract thing that has to worry governments. Like if you've got car finance or a mortgage or just grocery prices, right? This can have a knock-on effect to all of us.
Yes, I mean, the other side of what Pippa was saying about that period where interest rates were very, very high in the US and the UK and around the world in the 70s and 80s was house prices, for instance, were a lot lower, because it was the case that actually, if you're getting a mortgage, the amount you're just paying just for the interest on that is going to be so much higher. And so the amount people are able to spend ends up falling. And so if we went to a world, just to take one example, where interest rates went from sort of the 5-ish% they are right now up to 10%, 15%, I mean, we'd expect a dramatic fall in house prices, for instance, first of all. I mean, depending on how you got there, a lot of also other things would also break as well. But even in the more day-to-day sense, the cost for the government to borrow money, conventionally we think of the government as being basically the safest person you can lend money to. Not least because in America or Britain, they literally own the money printer. They can always print more money to pay you back. And so in a way that's different to even the safest business, even if you're lending to Apple and they have a massive cash pile of hundreds of billions, it's even safer than that to lend to the American government. And so that's sort of the benchmark on which interest rates everywhere else in the economy are set. So that then determines how much, or in large part, how much your mortgage rate is. That determines how much your credit card interest rate is, determines how much auto financing is. You can go all the way down the list. And so exactly as Pippa says, that percolates through the economy, and when we're seeing that.
And also, Pippa, the more it costs governments to borrow, whether it's in the US or the UK, because our government borrowing costs have shot up as well, the less they have to spend on everything else.
Yeah, and so again, we have to come to, all right, what's the way out? And so the usual option is you cut spending. And then everyone feels the pain of the loss of things like social programs. In the US right now, the administration's taken a very different approach to the problem and said what we need to do is really stimulate entrepreneurs and the creation of new forms of technology that will lower the cost of living for everybody in the longer run. So, for example, encourage the development of new small modular reactors so that we can have less expensive, more reliable energy. So the new data centers, for example, don't have to pull on the local power supply as they have been. So what you're doing is trying to shift capital away from the world of funding governments to the world of funding the entrepreneurs who are building tomorrow and trying to pull the future forward faster. The question is, do you believe that that can be done? And here the world is split. In the US, I'm in Austin, Texas, where the economy is booming. People are building incredible things at incredible scale. Batteries, cars, semiconductors, physical build. And the president has had a high emphasis on bringing back manufacturing into the US economy. That is definitely happening. Whereas Britain, where I lived for many years, there's a sense that you don't manufacture anymore and you can't. I don't believe that's true. I believe Britain has some of the best engineers in the world. What they don't have is a means of capital reaching them so they can scale what they do. So the solutions you see in the US and the UK are very different to the same problem.
And Archie, Andy Burnham, he says he was sort of quoted out of context, but he made these remarks about being in hoc to the bond markets. And I suppose now there's a danger really that we are, and that a lot of the stuff he wants to do as a new prime minister, he can't.
Yeah, well, there are two ways not to be in hock to the bond markets. One way is stop asking the bond markets for quite so much money, and then they'll have you over the barrel a little bit less. And the other way is to blithely ignore them, do what you want, i.e. sort of plead for more money and see where you get to. And that second route in the most extreme case was, of course, where we got to with Liz Truss, and British listeners will be well aware of exactly how that sort of chaos ended. I think if you're trying to be charitable to Andy Burnham, you'd focus on the first interpretation. And this was a version of what Jeremy Hunt was trying to do, what Rachel Reeves are always trying to do. We'll see what John Healey, the current chancellor, the new chancellor, gets to in his first budget. But the real question is, can you get to a stage where the combination of the amount the government's trying to ask for, and as falling out of that, the amount of growth we expect in the economy, because of course the big issue in Britain is the lack of growth, which then fuels tax revenues and means the government gets more money from tax and so needs to borrow less. If that gets to a stage that looks more reassuring, where bond markets look more confident and so on, then we could be in a better place. Britain, as it happens, actually, is in some ways better position than America on the fiscal situation. That might sound like a funky thing to say in a world where British bond yields recently have been even higher than America's, where certainly the panic in Britain is deeper.
And when you say that, Archie, just before you go on, when you say Britain's bond yields have been higher, what's the kind of user-friendly version of that?
Yeah, so that means it's more expensive for Britain to borrow in pounds than it is for America to borrow in dollars. And so if you're thinking about, if you're the government, how much you're going to have to spend on just like paying the interest on your debt, not even on doing other things, the bond market has Britain in a slightly worse position on that front than America. So that might be a reason to worry. But actually on the fundamentals, on literally how much is Britain asking for relative to the size of its economy, Britain's actually borrowing a lot less. The British government's borrowing a lot less every year. Its deficit is lower in the jargon than America's is. And right now, Britain's still a bit more worried, but that might actually mean in the very long run, Britain could be in a slightly better position.
And Pippa, why is it the case that the US has a bit more wiggle room when it comes to these eye-watering sums of money it wants to borrow? It's not quite the same, is it, when America's debt ratchets up compared to a country like Greece, for example?
Well, it's partly a function of size, right? The US economy is so vast and deep. So it's not even comparable to Greece or even, I mean, there are only a handful of economies in the world that even come close. And arguably, not even China is as large as the US economy. So it's partly that. It's also partly that the US has a big emphasis on the entrepreneurs who are building and growing the economy of tomorrow. And so everyone wants to know, is that going to work, right? Is, for example, Elon Musk going to succeed with this vast amount of capital that he's raised, or is it going to fail? Will the artificial intelligence companies succeed or fail? And part of what we're seeing in the bond market is some question about, wait, it's one thing if they have a big debt problem, but if they can grow their way out of it, then I'm okay. But maybe they can't. So this may be reflecting that more than the debt itself.
Yeah, and that's where the AI bubble comes in, isn't it? Because they've been spraying money around on AI in the US, and it's basically a huge gamble, isn't it? What happens if that pops, that bubble?
Well, this is the question in the financial markets right now. And is it popping right now? Is that what is driving all this fear? But at the same time, there's no question that artificial intelligence is vastly transforming all of our economies for the better. Now, this is a big debate because people think AI, automation, robotics are going to create massive job losses and basically replace humans. I take a very different view that actually they create jobs, but new ones, different ones, which means people have to change the nature of the work they do. But until that argument is actually settled by reality, and we see that we can work in much more effective ways with these new tools, people are afraid that not only are interest rates going up, but everybody's going to lose their job. And actually, the two countries that have the most robotics, automation, and AI, South Korea and Sweden, are net job creators. And as someone who's been in manufacturing myself, I see job creation, but it is a transition that people don't yet understand or feel totally comfortable with.
Archie, explain to me the tipping point where this turns into like a fire sale and it gets really serious, and then we really are in the expletive.
Yes, it's a bit like a bank run. You panic when everyone else panics. And so that's that right now no one's quite panicking. We have a podcast saying this is concerning. There I'm sure will be lots of coverage of hitting this threshold. If you wander around talking to economics wonks in Washington, as I sometimes find myself doing, they're certainly not thrilled, but it's not quite cut through yet. And I think the way that goes, and the Liz Truss experience might be revelatory in that way, where that was a very clear catalyst. There was something that happened that very, very sharply caused everyone across bond markets to go, oh gosh, I need to rethink how I treat British government debt, because suddenly the British government is doing an awful lot of unfunded tax cuts that are going to have to be funded by borrowing. In America, we've not had an equivalent experience yet. And so you can imagine that coming, well, you can imagine it being fixed, and maybe American politicians wake up and kind of knock their heads together and fix this as they sort of did in the 90s. You can imagine maybe AI bails them out, although I'm quite cautious about that.
And you think AI, just before you go on, Archie, AI might bail them out because you might get a return on that huge investment. Is that the thinking?
You might get so much growth and so much tax money from that growth that America can actually just pay off all the borrowing it's done. And that would be the real bull case. And I'd be pretty cautious about that. And I wrote a piece for The Economist actually 2 weeks ago saying in a weird way the bond market had also become a bet on AI. People always talk about the stock market being a bet on AI because if the AI bubble, as you said, pops, then a lot of these companies will be in an awful lot of trouble. But that's actually in a strange way true of the American government too, in the sense of if they're not going to get their house in order on government spending in the old-fashioned way by maybe raising taxes, by maybe pulling back some social spending on pensions or healthcare, whatever it might be, then you just have to sit back and pray that you get more tax money, and the only game in town there is AI.
And Pippa, just how much of a time bomb is this 40 trillion US dollar debt potentially?
Well, again, from the administration's point of view, it's a very serious problem, which is why they are coming up with new financial tools to be able to fund the new businesses in the US. So we're going to hear a lot more about, for example, stablecoins. These are a new instrument that have to be collateralized by US treasuries, meaning to own them, you also have to own treasuries. So it's a mechanism for compelling the world to buy US treasuries, which
treasuries are US bonds.
Those are the US bonds. Right. So you're creating a demand. But the key is that they can then be used to finance regular businesses. And one of the problems we've had in the States is that Wall Street and Silicon Valley have only really been interested in funding what we call unicorns, meaning companies that were going to be worth $1 billion in a very short period of time. But what about a half a unicorn or a quarter unicorn or even a local grocery store? Stablecoins become a way of widening the pathway for capital to get to regular businesses more easily than before. And then that would spur more growth. So this is what I mean by they've thought through that, yes, this is a break glass and emergency moment, but yes, there is a way to grow without just throwing cash at the system in the old quantitative easing sense. This isn't printing money. It's creating a new kind of financial mechanism that requires the world to put more capital into the US bond market.
This was a president who almost discovered the word affordability during the last election and fell in love with it. How do you kind of square that with where we are now with the debt and the prospect of inflation in the US?
Yes, well, this is, again, why we see so many announcements from the White House on science policy. What they're saying is, for example, the new nuclear or the new approaches to energy, the drilling of oil in the United States are all ways of reducing the energy costs. That's affordability. That is how you get the economy back on track. The rest of the world's taken a very different view about energy. Britain, for example, has taken a very different view about energy. I think Andy Burnham has recently changed the approach somewhat. But this idea that the way you address the affordability is you finance the creation of cheaper energy.
Pippa has touched on it, Archie, but just talk to me about contagion. What happens in the US percolates around the world, and that's what we've been seeing, isn't it?
It does. And there were some unfortunate scenes, say last year in Britain, where you had Rachel Reeves hauled up in front of Bloomberg News to reassure bond investors that Britain was fine, basically because there had been some chaos in the US, in the American bond market, and that had percolated over to the British one. And it's quite unfortunate that if you're someone like Britain, British bond movements follow American ones quite closely. Often kind of capital allocators kind of treat these things as moving together. And so you could be in a situation where chaos in America, actually, even if the British government is trying to do the right thing, might make Britain's job harder. It is worth saying that if you look at, say, Switzerland, which has a much, much more stable fiscal position, the government's not borrowing anywhere nearly as much. Their bond yields, the borrowing costs correspondingly much lower. If you really get your house in order, I think in any world you're fine. You even might become what investors call a safe haven, where the sort of place where if things really go completely wrong, you're the place that people flee to. Historically, that might be somewhere like Switzerland. It used to be Japan, ever less so, I think these days, because they have their own problems. So if Britain really, really righted the ship, that'd be one thing. But certainly if we're kind of puttering along as we are right now, then exposure to America is going to be pretty real.
Okay. Any final thoughts? Any sense of whether this is all going to blow up in our faces imminently, or have we got a bit of time to get our things in order?
I think the thing is that no one should be assuming that the interest rate is a fixed thing. We all have to assume that it has a certain swing up and down. And so whenever you make buying decisions, you should be thinking, well, what would happen if interest rates went up by another %? What would happen if they went down? Instead of, I love this number and I'm going to lock my life into this interest rate that I see in front of me, think of a band instead.
Archie, are you worried?
I'm worried, but look, you need there to be a crisis for someone to solve the crisis. And so I think we're at a stage where people are worrying, and the question is, how long does it take for the worries to cause action? And they haven't yet. I can't see that happening immediately, but I'm sure they will at some point. The question is just where.
Archie Hall, Pippa Malmgren, thank you so much for joining us on the Fourcast.